Good morning everyone. Today, we are going to discuss the interest rate and bond valuation. Our goal in this chapter is to introduce you to bonds. One important thing we learn is that bond values depend in large part on interest rates. We therefore close the chapter with an examination of interest rates and their behavior. So before we start, let me tell you the learning objectives of our topic. At the end of this discussion, you will be able to define important bond features and types of bonds, describe bond ratings and what they mean, outline the impact of inflation on interest rates, and lastly, know the term of structures of interest rate and the determinants of bond yields. So now, let's start the discussion by identifying the meaning of bonds. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. Typically, a bond can be corporate or governmental. A bond is simply negotiable IOU or loan. The bond has some key terms. The first one is the face value. When we say face value, it is the principal amount of the bond that is repaid at the end of the term, and it's also called par value. The second key term is the coupon. It is the stated interest payment made on a bond. The third one is the coupon rate. The coupon rate is basically used to get the interest payment of a bond, and for us to get the interest payment, we are going to use the formula of coupon rate, which is the annual coupon is divided by the face value of a bond. The fourth is maturity. It is the specified date on which the principal amount of a bond is paid. And lastly, the yield to maturity. It is the rate required in the market on a bond. It is also the discount rate that makes the present value of the coupon and the principal payments equals to the price of the bond. Next is the interest rate risk. Interest rate risk is the risk that arises for bond owners from fluctuating interest rates. How much interest rate risk a bond has depends on how sensitive its price to its interest rate changes. This sensitivity directly depends on two things. The first one is the time to maturity, and the second one is the coupon rate. As we will see momentarily, we should keep in our mind the following when we are looking at a bond. All things being equal, long-term bonds have more interest rate risk than short-term bonds. All things equal, low coupon rate bonds have more interest rate risk than high coupon rate bonds. As you can see in the figure, we compute and plot prices under different interest rate scenarios for 10% coupon bonds with maturities of 1 year and 30 years. Notice how the slope of the line connecting the price is much steeper for the 30-year maturity than it is for the 1-year maturity. This steepness tells us that a relatively small change in interest rate will lead to a substantial change in the bond's value. Intuitively, we can see that longer-term bonds have greater interest rate sensitivity because a large portion of a bond's value comes from $1,000 face amount. The present value of this amount isn't greatly affected by a small change in interest rates if the amount is to be received in 1 year, even a small change in the interest rate. However, once it is compounded for 30 years, can have a significant effect on the present value. As a result, the present value of the face amount will be more volatile with a long-term bond. Yield to maturity. As we said earlier, yield to maturity is the market required rate of return implied by the current bond price. Also, yield to maturity should not be confused with its current yield. When we say current yield, it is the annual coupon divided by current price of the bond. For us to find the value of the bond, kindly refer to the figure below. As you can see, the formula that are going to use in getting the bond value is stated in this figure, wherein the letter C stands for coupon paid each period, R is the rate period, P is the number of periods, and letter F is the bond's face value. Now, for you to understand the topic that we discussed to you, we have an illustration here. You're looking at two bonds identical in every way except for their coupons and of course their prices. Both have 12 years to maturity. The first bond has a 10% annual coupon rate and sells for $935.08. The second has a 12% annual coupon rate. What do you think it would sell for? Now, for our analysis, we first need to calculate the yield on the 10% coupon bond. We know that the yield must be greater than 10% because the bond is selling at a discount. A little trial and error reveals that the yield is actually 11%. Now, let's move on to the solution. First, we will get the bond value with a 10% coupon rate. Bond value is equal to $100 times 1 minus 1 divided by 1.11 raised to 12 divided by 0.11 plus 1,000 divided by 1.11 raised to 12 equals $100 times 6.4924 plus 1,000 divided by 3.4985 equals $649.24 plus 285.84. Then after that, we will get the bond value which is $935.08. Now, we will now get the bond value with a 12% coupon rate. With an 11% yield, the second bond will sell at a premium because of its $120 coupon. Its value is $120 times 1 minus 1 divided by 1.11 raised to 12 divided by 0.11 plus 1,000 divided by 1.11 raised to 12. $120 times 6.4924 plus 1,000 divided by 3.4985 equals $779.08 plus 285.84 is equals to $1,064.92. In this topic, we are going to identify the differences of the debt and equity with the help of the key features stated in the table below. The first key features of the debt are not an ownership interest. Means, if you are the creditor or the one that is making the loan, you do not have any ownership in the company. No voting rights. You do not have any voting rights for the corporation or for the entity. Third is interest is tax deductible. Fourth, creditors have legal recourse if interest or principal payments are missed. And lastly, excess debt can lead to financial distress and bankruptcy. On the other hand, equity also had 5 key features. The first key feature is ownership interest. In this point, once you are equity holder of an entity, you do have an ownership interest. Second, if you are common stockholder, you get to vote to elect the board of directors, and you have the right to vote on other important matters for the corporation or the entity's point of view. Third, dividends are not tax deductible. Fourth, dividends are not a liability of the firm until declared. Stockholders have no legal recourse if dividends are not declared. And lastly, an all-equity firm cannot go bankrupt. So now, let's move to the next topic, which is the long-term debt, the basics. Ultimately, all long-term debt securities are promises made by the issuing firm to pay principal when due and to make timely interest payment on the unpaid balance. The maturity of the long-term debt instrument is the length of time the debt remains outstanding with some unpaid balance. Debt securities are typically called notes, debentures, or bonds. Strictly speaking, a bond is a secured debt. However, in common usage, The word bonds refer to all kinds of secure and unsecured debt. Long-term debts have two major forms. Can be public issue and privately placed. The main difference between public issue and privately placed debt is that the latter is directly placed with the lender and not offered to the public. Indenture is the written agreement between the corporation and its creditors. It is sometimes referred to as the deed of trust. Usually, a trustee is appointed by the corporation to represent the bondholders. The indenture is the legal document. It can run several hundred pages and generally make for tedious reading. It is an important document because it generally includes the following. Number 1 is the basic term of the bonds. Number 2 is the total amount of bonds issued. Number 3, a description of property used as security. Number 4, the repayment arrangement. At repayment arrangements, bonds can be repaid at maturity, at which time the bondholder will receive the stated or face value of the bond. Number 5 is the call provision. It allows the company to repurchase or call part or all of the bond issue at stated prices over a specified period. Number 6 is details of the protective covenant. Protective covenant is part of the indenture or loan agreement that limits certain actions of a company. Protective covenants can be classified into two types: the positive and negative covenants. A negative covenant is thou shall not type of covenant. It limits or prohibits actions that the company might take. A positive covenant is a thou shall type of covenant. It specifies an action the company agrees to take or a condition the company must abide by.
So for the bond feature, first of all, before we tackle the different feature, who does the payment belong to? Or who does the bonds belong to? In the register foreign bond, this is a bond where the registrar of the company will record ownership of each bond, so when is the time for entrance and principal payments to be paid, it is made directly to the owner of record. Now, in bearer bonds, the form of bond issued without the record of the owner's name. Whoever holds the bond made the payment. So because of the disadvantage of bearer bond, first, it is hard to recover if they are lost or stolen. Then, it cannot notify the bondholders of important events because the company does not know who owns its bond. So most of bonds is registered form. Next is the security. It says here it is a collateral and mortgage used to protect the bondholder and has a different types. First will be a collateral. These are just like bonds and stocks that are pledged as security for the payment of debt. An example is a collateral trust bond often involved a pledge of common stock held by the corporation. Then mortgage is secured by real property, normally land or building. On the other hand, debenture is an unsecured bond. Typically has a maturity of greater than 10 years, so you can only claim the property that remains after your mortgage secured bonds and collateral secured bonds are taken into account. So, this is a high risk level of these different types of bonds. Now, in notes is also an unsecured debt that have a original maturity of less than 10 years. Seniority indicates preference in position over other lenders. So when you are paid, you can be a senior versus junior or a subordinate. And then, repayment bonds can either be repaid at maturity or they may be repaid in part or entirely before maturity, and they create what is called a sinking fund, an account that is managed by the bond trustee for early bond redemption. So in here, the company made annual payments to the trustee who'd use the funds to retire a portion of the debt. So this is to make sure You are not short on cash when the bonds mature. Other bond features, we have call provision. So why would the company exercise a call provision? Simple. If interest rates out in the market go down, let's say it's a $1,000 par value bond, and so the price of the bond now goes up to 1400s, so there's inverse relationship. And this bond has a call provision, the company can rebuy it in 1300s, so they can pay less than what the market prices and retire that bond and then reissue debt securities at these lower interest rates. So this is how call provision works. So there's a call premium is the amount which the call price exceeds the par value of the bond. So in the example earlier in call provision, the exceed amount is 300. Now, in deferred call provision, it is prohibiting the company from redeeming a bond prior to a certain date. So maybe it is a 30-year bond with a 10 years deferral call provision. So they have to wait 10 years before they could even think about exercising the call option. Then, we have a call protected bond. During a certain period, cannot redeem by the issuer. So for example, for the first 10 years of prohibition, call protected bonds occur. Additionally, the indenture may include what are call protective covenants. It has two types, negative and positive covenant. A negative covenant is a thou shall not type of covenant. It prohibits or limits action the company might take. Some examples states that firm must limit the amount of dividends it pays. They cannot pledge any assets to other lenders. They cannot merge with other company. So, in positive covenant, it is a thou shalt type of covenant. It specifies an action the company agrees to take or condition the company must abide by. So here, we can see the example of bond certificate. So, we can see here that something is circled in the picture. It is where the term coupon comes from. It used to be would literally rip off a coupon, mail it in, and that's how you got your interest payments. In this picture, you can see the different features on the particular bond. We have a registered bond, so the company has registered the ownership of the company of the bond is listed and the company's registrar. Par value 1,000, 4.25% coupon, convertible bond. You are subordinated in terms of your payments. There is debenture, so there is no security, and other different features that we just discussed is listed on this bond. There are also some different bonds. Government bonds, which is the biggest borrower in the world. Under government bonds is the municipal securities, is the debt of state and local governments. They have varying degrees of default risk, so they are rated similar to corporate debt. It also exempt from federal income taxes, and oftentimes it exempt from state tax in your issuing state. In zero coupon bonds, it is similar in your discount loans. No interest payments are paid during the time frame of the loan, and they are priced at a huge discount. Another type of bond is what we call floating rate bonds. This is where coupon rate fluctuates or float depending on some index. Usually, it's tied to an interest rate index. With these floating rate bonds, there's less interest rate risk. Remember that interest rate risk is the concern primarily that interest rates go up and the price of bond goes down. Some other types of bonds, we have the income bonds. It's similar to conventional bonds, except that coupon payments depend on company income. Particularly, coupons are paid to bondholders only if the firm's income is sufficient. It may be an attractive feature, but these bonds are not very common. Next type of bond, we have convertible bond. So it is going to be at some predetermined ratio. So what a convertible bond allows you to do is share in the good fortune of the firm. These convertibles are relatively common, but the numbers been decreasing in recent years. Last type of bond is what we call put bond. So basically, it is the opponent of a call provision. In this case, you are forcing the issuer to buy it back at some stated price. This may occur when interest rates out in the market go up and the price of bond goes down. And if it would go down below that put price that says that the put price is 800 and interest rates out in the market have gone up so high that the market price has gone down to 700, you could exercise put provision and sell it back to the company at that put price as opposed to what the current market price is lower than that. So now is where the bonds are bought and sold. So most bond trading occurs over the counter. So in the over the counter market, there's no particular place where buying and selling occurs. Basically, it used to be that you would go up to a counter and trade over the counter. But now, all the dealers are linked electronically, so dealers are linked electronically, buying and selling out of their own inventory. And so, you're buying and selling linking to other dealers over this electronic network.
Treasury bonds. Here we see an example of treasury bonds from the Wall Street Journal. So let's see what the information is shown here. So in this table, it shows here that the entry started in August 15, 2013. And this information tells us that the bond will mature in August of 2013. The next column is the coupon rate, which is 12% for this bond. The next two pieces of information are the bid and ask price. In general, in any OTC or dealer market, the bid price represents what a dealer is willing to pay for a security. And in the table, they are willing to pay 103 of par value if they are selling. Next column is the ask price. It is what a dealer is willing to take for it. So here in the first entry in the table, the dealer is willing to take 103 and 01. The difference between the two prices is called the bid-ask spread or just spread, and it represents the dealer's profit. Next column is the change. It is the price change from the previous day. So in the table, the price change from the previous day is -2. And the last column is the YTM. YTM is yield to maturity, and it is based on the ask price. So if I'm going to buy it, I'd be paying the amount of the ask price, and from there, we calculate the yield based on that price. Treasury quotation. Bid price. We mentioned this before. It is the price in which the dealer is willing to buy from you. Ask price. We also mentioned this earlier. The ask price is what the dealer is willing to sell at. Bid-ask spread. It was also mentioned earlier, the difference between the bid price and the ask price. So let's go to the quoted bond price and invoice price. So quoted bond price or clean price, the price of a bond net of accrued interest. This is the price that is typically quoted. Invoice price or dirty price, the price of a bond including accrued interest, and this is the price the buyer actually pays. So sometimes, if we buy a bond between coupon payment date the price we pay is usually more than the price we are quoted. The reason is that standard convention in the bond market is to quote prices net of accrued interest, meaning that accrued interest is deducted to arrive at the quoted price. This quoted price is called the clean price. So the price you actually pay, however, includes the accrued interest. This price is the dirty price, also known as the full or invoice price. Inflation and interest rate. In examining interest rates or any other financial market rates, such as discount rates, bond yields, rates of return, and required return, it is often necessary to distinguish between real rates and nominal rates. So nominal rates are called nominal because they have not been adjusted for inflation, while real rates are rates that have been adjusted for inflation. So the difference between nominal and real rates is important and bears repeating. So the nominal rate on an investment is the percentage change in the number of dollars you have, while real rate on an investment, it is the percentage change in how much you can buy with your dollars. In other words, the percentage change in your buying power. The Fisher effect, the relationship between nominal returns, real returns, and inflation, and it can be written as 1 plus R equals open parentheses 1 plus R close parentheses times open parentheses 1 plus H close parentheses, where H is the inflation rate. So our discussion of real and nominal returns illustrate a relation often called the Fisher effect. Because investors are ultimately concerned with what they can buy with their money, they require compensation for inflation. So let's go to figure 7.4, the Fisher effect. If investor requires a 10% real rate of return and the inflation rate is 8%, what must be the approximate nominal rate and the exact nominal rate? So the nominal rate is approximately equal to the sum of the real rate and the inflation rate. So 10% plus 8% equals 18%. From the Fisher effect, we have 1 plus R equals 1 plus R times 1 plus H. So we have 1.10 times 1.08 equals 1.1880. Therefore, the nominal rate will actually be closer to 19%. So it is important to note that financial rates such as interest rates, discount rates, and rates of return are almost always quoted in nominal terms. Determinants of bond yields. So we are now in a position to discuss the determinants of bond yields. As we will see, the yield of any particular bond reflects a variety of factors, some common to all bonds and some specific to the issue under consideration. So the term structure of interest rates. The relationship between nominal interest rates on default-free, pure discount securities and time to maturity, that is the pure time value of money. So the relationship between short and long-term interest rates is known as the term structure of interest rates. To be a little more precise, the term structure of interest rates tells us what nominal interest rates are on default-free, pure discount bonds of all maturities. These rates are in essence pure interest rates because they involve no risk of default and a single lump sum future payment. In other words, the term structure tells us that the pure time value of money for different lengths of time. When long-term rates are higher than short-term rates, we say that the term structure is upward sloping. When short-term rates are higher, we say it is downward sloping. So sa second bullet, yield curve, graphical representation of the term structure. Normal plus upward sloping equals long term is greater than short term. Inverted plus downward sloping equals long term is less than short term. Here we can see the example of upward sloping. So let's notice how the rate of inflation is expected to rise gradually. At the same time, the interest rate risk premium increases at a decreasing rate. So the combined effect is to produce a pronounced upward sloping term structure. So this is the downward sloping yield curve example. So here, the rate of inflation is expected to fall in the future, and the expected decline is enough to offset the interest rate risk premium and produce a downward sloping term structure. Notice that if the rate of inflation was expected to decline by only a small amount, we could still get an upward sloping term structure because of the interest rate risk premium. Thank you.